So anyways, he's quite familiar about talking with young farmers. So I think he's got some good topics in terms of addressing for you. And Larry, do you want to mention what some of those were?
Oh, I took notes and I don't have them in front of me.
Okay.
So I can't. No, I can't off the top of my head.
Okay. Okay. Anyways, so if you guys can mark, that will be the next go-to session. Will be February 21st. So put that in your calendars. And I'm not sure actually if Larry and I need to look at our C-Team schedule because we're going to be in Vancouver that week with C-Team. So the go-to invitation might come from me. I think, Larry, we need to look and see where both you and I will be that afternoon at 5 o'clock Pacific.
Yeah. Okay. So if we are ready, I'm going to start. Actually, a number of the slides here you've seen before, but I thought it would be good to set up what we're going to do for the content stuff by going back and talking about them. So why don't we play the slideshow, Larry? Okay, can everybody see that? Did my slide just change to finance module objectives?
Yep. Yeah, you bet.
Yep.
Yeah, yesterday morning or this morning when I was had my marketing call, it froze, and I was 5 slides into or five charts into my conversation, and they were still looking at the first one. So I just want to make sure it works. So our objectives for the module, just to remind you, are to hopefully help you understand the basic principles of finance. Josh probably can help us because he's actually been a banker along the way. Understand finance from the perspective of the manager. So we talked about the financial statements and the operating management, but we're going to try to connect strategy and planning a little bit and budgeting to it, and hopefully in this component, and then understanding stuff like investment, financial structure, ratios, working capital, sources of finance. Well, we won't probably talk about sources of financing so much, but we will do the other. We'll talk about the ratios and working capital and that sort of thing in this session. Decision make. So managers have to make decisions. They have to do financial planning. They have to do strategic planning. They have to secure and manage funds. They have to have financial controls, measurement, and analysis. And so last time we talked about what the financial statements are. Now what we want to do is now talk about, from the manager's perspective, how do you use them for some of these decisions. And again, this is a repeat of what we said before, but where managers have trouble, and trust me, I am seeing this in big time in a couple of people I'm working with at the moment. Number one is failing to manage cash, so they don't project cash flow, and they end up needing cash when they don't have it. Probably, I think we talked about this the last time, but the thing that is probably the biggest source of failure for startup businesses is not having enough cash. You often underestimate how much you need, and you don't generate it as fast as you expected to, and therefore you get into a cash crunch and take out of it. Failing to manage working capital is a special case of that. We'll talk about what working capital is here pretty soon, but sometimes people let the receivables go too long, and they end up stuffing sometimes their suppliers because their creditors aren't paying them. And I've actually been around a number of companies that have trouble with this inventory issue. Controlling inventory can be really, really costly. And then failing to manage costs and margins. And we'll talk about this tonight because of some of the ratios we want to talk about on the operating statement that will help you get to at least identify where you've got problems with that. because we've got some benchmark ratios we want to use here. Another issue is that, and again, I see this thing pop up in front of me, and I'm thinking about somebody I'm working with at the moment who borrowed exuberantly to expand, went too fast, got in trouble, and it was mostly on low return investments. There's some toys and hobbies in this business also that should not have been bought, most likely, at least not until the cash flow got better. Sometimes you'll see people have problems. I've seen this on a number of financial statements recently. They use their operating line to lend to pay for long-term assets, and that usually gets you into a problem because it's not what you're supposed to do with your operating line. And one of the biggest issues is overlooking reality by not being really clear and asking yourself whether you're being real when you construct budgets for future investments. Then another one is the issues of communication. Probably the worst one is the middle one, when you get yourself into or you find yourself in trouble and you don't tell your shareholders, or you don't tell your lenders, and it comes as a shock to them. Generally, what we will tell people is that, especially with your lenders, they don't particularly want to foreclose on you. So if you keep them informed and you've got a problem, they'll help you oftentimes figure out a way to refinance it or work around it somehow or other so you can get out of it. I got 2 or 3 examples of people I'm working with here who at the moment, when they've got financial difficulties, if they tell their employees that there's a problem and the employees understand the problem, lots of times employees have really good solutions to the problem and they want to work along with you because they don't particularly want to lose their jobs and the like. So failing to communicate, and I suppose probably behind this in many cases is the more fundamental issue is you're not communicating because you don't know, because you haven't got the right data. So it's understanding what data you need and making sure you communicate it to the right people that really makes a difference. Okay, and I've added one tonight because, and I think it goes back to our strategy stuff. I think management often doesn't understand, or planners often don't understand, the relationship between finance and strategy. And I'll try to bring that out in what we're going to do tonight. Some financial ratios can tell you very much about your management performance or your production. When I say management performance, I mean production and or marketing performance most likely. They can provide clues to where you should focus your efforts. I'm going to end up tonight with a little exercise where we look at that and see if we can see it. And they can give you a lot of information on whether to expand. As I said a couple minutes ago, one of the problems that people get into sometimes is they expand too fast. They may not have the financial wherewithal to expand, but they also may not have the management expertise to expand, and so it just gets to be too much for them. I was on the board of directors of a company that started off with a very small operation, got really big, brought in outside capital, and the CEO finally got fired by the outside capital and lost all of his equity in the operation because he just went too far too fast and couldn't manage it, and plus he had trouble financing it at the same time. So those are some of the things I think as you grow over time you want to avoid. It's so nice. I'll just say this, that I'm working with a couple who took C-Team a couple of years ago, and they're nominated for Outstanding Farmer of Alberta. In fact, I think they're going to be there this week for the competition, I guess, is whatever you call it. And I really got to see over the last little while, as I've been working with them, how they have grown over time. And it's kind of like, I hope I'm going to describe tonight, that they took a bite and they chewed it, they figured out how to manage it, they paid down the debt, and they took another bite, and so forth. And their progression has been phenomenal, actually, over time, both in terms of profits and net worth and that sort of thing. And it's the way I like to see people do it. So hopefully we'll be able to talk about that process tonight. This is also one that Heather talked about the last time, and it's one I have the distinction in the C-Team program of being laughed at all the time because I focus so much on EBITDA, and I really do, because I think it is really important. If you buy something, I hope some of you can turn on your unmute and answer this question. It's kind of a silly question in a sense, but if you buy a farm or if you buy a major asset, how do you pay for it? What pays for it? Anybody got an idea?
Are you talking in terms of going out and getting some new capital via a loan?
Yeah, but you eventually have to pay back the loan. So I'm not asking you how you finance it. I'm asking you how you finally pay for it.
Wouldn't it be cash generated by your operation?
Exactly.
Down payment, and then
facetiously there are three alternatives. One is that you buy an asset and it generates cash that pays for itself. Two is you have a rich uncle. Or three, you're going to have a sale. That's not the funny part. The sale is what the one that happens when you can't generate enough cash for it. You don't have a rich uncle, and you go bankrupt. So you end up having a sale. So being able to generate cash from an investment is crucial. And I think Heather talked about this slide. But it's one that I think is fundamental to the whole concept of management. That is, after you paid your operating earnings, what you got left is earnings before interest, taxes, depreciation, and amortization. That cash that's left over after paying your operating costs, and as it says here, it serves four masters. Number one, we'll start with that one first, the last one first. You got to pay your taxes. Okay. So once you paid your taxes, then there are three things you can do with that cash. One is to pay lenders, principal and interest. The second is to use it for working capital or to invest in new assets and to leverage it if you need to into more debt. And the third one is to pay yourselves. We often think about in kind of a textbook financial thing that the steady state of an operation, after you pay your taxes, generally, if you want to just keep going and not grow, you think about a third. A third goes out to shareholders, a third goes to lenders to pay principal and interest, and a third goes into new investment. But if you are at the stage many of you are, and you're growing, that's not likely going to happen. You're going to give less to shareholders, most likely. You being the shareholders, and you're going to try to use as much of that earnings as you can to invest in new stuff, which gives you more debt in many cases, which means that you've got to use more of it for principal and interest. Okay, but bottom line is, if you don't generate cash, you don't grow, and that's why, to me, this whole concept of understanding your operating earnings, and how much cash it's generating relative to your sales is significantly important. And we're going to get to that in a very few minutes here now. So maybe I preached about that enough. So I want to go back again and talk about this. This is our standard operating statement. And I'll show this several times again, but again, everything above EBITDA is operations. We break it into cost of goods sold, direct operating expenses, and your operating overheads. Everything below EBITDA is the management of capital, if you will. Okay, so that's depreciation, amortization, leasing and rental costs, and interest expense. And here's the balance sheet. Again, Heather talked about it, but I just want to make sure that we're clear and do a review here. The right side of this is the ownership, and in a sense, I'm being facetious a little bit when I say that. And the left hand side is what you own. So the assets are over here. This is what we own. And if you own it, that means that it's from equity, and if the bank owns it or somebody else owns it, it's from debt. So debt plus equity has to equal assets. Okay, and there's no way around it. This left-hand side has to equal the right-hand side, and the other point, I guess, that comes off of that is if you add up, if you subtract your from your total assets what your liabilities are, then what's left over is your equity. It's what you actually own in the business. I guess the other piece is that we always break the balance sheet into the current, which is basically what you have and what you need to pay in the current year, and then the longer term stuff is what's gonna last for longer than a year and what you're gonna pay for longer than a year. Okay. Any issues about that? We will, as I said, we will come back to these several times as we go through the ratios. So finally, I'm going to get into something new tonight. I am going to focus on, I said 5, but it ends up maybe being 6 or 8 ratios that I think are really important to understand as a starting point in financial management. This is just me. If you hear from other people, you'll probably hear some slightly different ones, but you're generally going to hear variations on the theme. So we generally categorize financial ratios that come from the balance sheet and the operating statement into 4 categories. We have the operating ratios, which are measures of how well your operation is running, and that's the one I'm going to start with in a minute. We have liquidity ratios, which are the things that measure how well you can service or you can meet your short-term financial obligations requirements. We have solvency, which measure how well you can meet your long-term financial obligations. So liquidity is the next year. Solvency is the longer term. And then we have profitability ratios, which measures your how profitable your operation is over time. So I'm going to break those. I'm going to break some of those down. There are many of them in each category, and I'm going to try to keep it to the ones that I think are most important, simply because hopefully that'll make it easier for you to understand them. You can, once you get the basics, you can expand them as much as you want to get into the literature. Accountants usually start with liquidity, but I don't. I think operations underpin everything, as it says here. If your operation doesn't generate enough cash, your financial management options are really limited, and that's the bottom line. You can't go out and expand and invest in new things if you don't have some EBITDA to work with. It's as close as that. It's as simple as that. So using the standardized income statement that we've talked about both the last time and this time, there are 2 operating ratios that I think are particularly important to use. And you'll see implicitly that there are actually 2 more in here. But if you force me to only talk about 2, it would be the operating efficiency ratio, which is EBITDA over sales, and the gross margin ratio, or the percent gross margin, which is gross margin over sales. And I'm going to talk about some standards for these that we have come up with. But the standards are very, actually, I'm talking about it from the perspective of our BDO study at the moment, but the standards are very close out of this to some others that we've seen over time. So what we're doing here, I'm going to make sure you see this. So my operating efficiency ratio is EBITDA divided by sales or revenue. My gross margin is my gross margin divided by sales or revenue. So gross margin is after I've taken off the cost of goods sold. EBITDA is after I've taken off all of the operating costs. Okay, so here's a summary of this piece that we just did. It's actually, I don't know if we sent this to you or whether it's on our website. It is on our website, whether we sent it to you or not. But this is from a piece we just finished. It's from 78 farms of BDO. BDO is now rolling out this in this next tax year to their accounts, all their farm accounts. So next year we're going to have several hundred farms that we can check this out on. But what we did is to take these 78 farms, and they are from across Canada. They are different types of farms. The biggest category is cash grain farms, but there's some dairy ones, there's some hogs, there's some cattle, a few horticulture operations in here. And what we did was to say on the basis of their profitability, and what we're looking at here when we say profitability is our earnings before taxes from operations. This one right here as a percentage of sales. And we also did it on the basis of earnings before taxes as a percentage of assets. So this is return on sales, and the other one would be return on assets. It didn't matter which way we measured it. The same 25% of farms pretty much showed up in it. The top 25% of farms in terms of profitability were the top 25% either way we measured it. So the way this table is set up is it's calculated on the basis of the top 25%, the average, and the lowest 25% of the farms based on profits per dollar of sales. And what this tells you when you look at the gross margin and the operating efficiency ratio is that for those 25% of farms, their cost of goods sold was 33% or less of their sales, which means their gross margin was 67% or more. So I'm going to generalize that to 65%. So basically the most profitable farms generate 65 cents.
Hello.
Hi, just about to ask if anyone else lost Larry.
Yeah, it's like he just dropped off the map, but he's still logged in. Just hang on, I'll see if I can get him.
Am I back?
Yes.
Hello?
Hi.
Hi, am I back?
You are.
Okay.
You're on.
Sorry about that. Okay, I'm gonna hang up on you on my cell phone, Heather. I don't know what happened. It just all of a sudden went gazonkers, and I was gone. It's like you all hung up on me. Okay, so where was it? So what this says is if you are in the top 25% farms, you're going to have 65 cents of every dollar of sales left over after you pay for your fertilizer, seed, feed, chemicals, that medicine, that sort of thing, depending on what kind of farm you are. If you're the worst farmers, or the least profitable farmers, I could say worst, the least profitable farmers, you're going to have 53 cents. Now, the interesting thing is the average gross revenue in this operation, in this sample, is about $3 million. So that difference between 33% and 47% is 14. Is that is 140,000 or yeah, be about $140,000 in gross margin on $300,000 or $3 million of sales. So it's a big number. Okay. So what does it say if you are above that, or below? Let's take the negative side. What does it say if your, let's say your gross margin is 60% instead of 65%? What is that telling you from an operating perspective? Why would it be lower?
It could be a number of things, like you are spending too much money on interest or
Nope.
non-profitable assets.
Nope. That's why I'm doing this, because it is very specific. It is what you got left after you pay for your seed, feed, fertilizer, chemicals, and that sort of thing. You haven't done anything with interest yet.
Then you're spending more on your input spending.
I think you're talking, but I can't hear you. Off in the distance someplace, somebody. So basically what this is revenue times price times yield minus your cost of goods sold, which are the feed, seed, fertilizer, and so forth. So there are three variables in here. Number one is the price of what you sell. Number two is the cost of what you buy. And number three is how efficiently you convert what you buy into what you sell. Okay? So if you are consistently below this, it means one of three things. It means one of three things, yes. It means you're not getting enough for your product, you're not getting enough yield of your product, or your cost per unit of the operations is too high. And it's persistent. If you benchmark and you know your yields are okay, then the question becomes: I've been involved with a greenhouse operation, and we had yield problems for a while. So that number was too low. We fixed the yield problems, and we still had the problem. So we finally convinced ourselves that we're growing the wrong thing, because it just wasn't paying us enough to grow the right thing. So we switched to a different product in the greenhouse. Okay, so that's all about your physical ability. No, it's not necessarily just physical. It's all about your ability to grow and market whatever you're growing and marketing effectively. So it's a really good benchmark. Yeah, go ahead.
Out of those three things, do you have any tips for tracking down which one or combination of those three would be your culprit if you're just starting out to look at this?
Well, here's the starting point for me. What's the easiest thing to benchmark in there? I think the easiest thing to benchmark is your yields. How are your yields compared to other people's yields? Okay, so if you're I think this would be the case. Now, argue with me if I'm wrong, but so if you can go around and see that everybody else is doing worse than you are or better than you are, then that's probably where you need to focus. If you can see that you're doing as well or better than others, then the question is, okay, are you somehow or other paying way too much for your inputs, or are you just not doing a good enough job of marketing? I've got a couple of my marketing clients who actually turn this around and say, okay, I know what my cost of fertilizer. This is relatively easy for a grain operation that has 2 or 3 products. It gets more complex as you get more products, obviously. But they're turning around and saying, okay, I know what my cost of fertilizer and seed and chemicals is going to be. I know what my yield should be. Okay. So now what price do I need in order to be able to make sure that I've got that, whatever my target here is, 65% or 70%. And then they'll use that as a way to say, when do I pull the trigger and do some marketing on this product? Now, you can't guarantee the yield's going to be there, obviously, but it becomes a really useful tool for a whole lot of things to gauge this. And I'm finding, like, I've been working with a company that is not in a farming business, but it's in a different kind of business, and they had a gross margin of 35% now, and it shouldn't be that. It's not the same kind of business, so it shouldn't be 65%. They had a gross margin of 35%, and they knew it was too low, and they started focusing on it. They did some price changes, they did some cost control, and so forth. And they got that up to 55%. So a 20% increase in gross margin, and it was somewhere in the neighborhood of $4 or $5 million in sales. Makes a huge difference. So this is one of those things that I think is really a useful tool to help you get some concept of what you should be doing here. And I don't know, did I answer your question okay about the benchmarking?
Yes, you did. Thank you.
Okay. Now I'm going to skip down to the other one. This one is 35%. This is after all of your operating costs. So this is your cost of goods sold, seed, feed, fertilizer, and so forth. Direct operating expenses will be your labor, and the cost of operating your machinery and equipment is the one that goes into there. Then your operating overheads, which are you're keeping the lights on, your accounting and that sort of thing should go in here. And after you pay all of those, you got 35 cents left on the dollar. And actually, to me, this is the one that I look at first, because if that one's a problem, if you got a problem someplace, I can see it here. If that's a 22% or something like this, which is, by the way, what the average is for Canadian farms, is about 22% on this one, back when we could get tax filer data. Then I can break it out and figure out where the problems are up here. I'm skipping over the contribution margin, but that is another major cost category for a lot of farms right there. So if you got a 70% gross margin and a 22% EBITDA, then you got a problem with your cost in here someplace. Okay, if you got a 70% gross margin and a 40% operating efficiency ratio, then you're in great shape along the way. But those two are two that just jump off the page at you to start with, in terms of using them as benchmarks to figure out how well you're doing. And in fact, here's where I kind of link it back to the. And sorry, I'm going to break in here and say I'm going to add something that I haven't got in the notes in the slides here. I am going to talk about the contribution margin a little bit. So contribution margin is what you got left after your gross margin and after you paid your cost of operating labor and the cost of operating your equipment. So this is not the capital cost of equipment. It's just fuel, repairs, maintenance, that sort of thing. So that should be, and I'm going to look at that cost itself. On average, it should be probably around 25%. This says 27, but I think we got some horticulture operations in there that make it a little bit higher. Okay, and if you got that to 25% and this at 35% and that sort of range, then you're probably going to be really good in terms of your EBITDA. So remember when we talked about the strategic planning area, having some notion about these is really important in the strategic planning. And I think I did bring it up toward the end of that conversation. If you are an operation that's got a 35% or 40% direct operating cost, and you're at say 30% or 28% in here, okay, you're not generating enough cash. And so one of your strategic intents, or part of your strategic analysis, your internal analysis should be to say, okay, we've got problems in our operations that we got to fix. I got one of the couples who just finished C team had a 40 in here, and they are in horticulture, and they know what their problem is. They've got too much labor around for the amount of product that they're generating. We can actually take this the next step and take their labor cost and divide it into their sales, and you get too low sales for your labor cost. Okay, so before we go off and invest in something new, you better figure out some way to use these guys more effectively in order to generate more revenue. And that's actually part of what their strategic intent is. They are actually investing in something a little bit different, but it's a reasonably low cost investment that's going to help them utilize their labor much more effectively. So maybe that's an illustration of what I mean by this. Knowing these really helps you identify where you've got a problem, and that helps you with your strategic planning process. Okay, so if these ratios are out of whack, that's the first place you want to start looking. Am I making sense with that, I hope?
Yeah, can I just add something to that? I think one of the things is to be make sure when you're looking for your benchmarks. So Carmen, in where we farm, obviously, you have a lot of different soil zones. So you really need to be conscious in terms of where you're looking, where your yield production benchmarks are coming from. And in terms of pricing for looking for averages and stuff. Larry, I'm not sure if you can speak to the other commodities out there.
Yeah, well, I think I'm going to do that here with this. I'm going to get this in the next slide or two.
Okay. Sorry.
Okay, so, yeah, go ahead.
Information
go ahead.
Would crop insurance be a good source for that information, or where do you get that from?
You used to be able to get reporting from crop insurance, which give you an average yield in your industry. I have to look. I have not seen one of those for a while. But you can always look through Alberta Agriculture for resources. And in terms of costing, you can go back and they will give you average cost of productions. So you can kind of get, but again, depending where you're at and depending how much fertilizer you're putting on, you really just need to be conscious about where that data is coming from, that you're comparing apples to apples.
Yeah, Alberta and Saskatchewan both have really good budgets, but Heather is absolutely correct. You got to be careful because you got black soils and brown soils and so forth. You got to be careful about it, but they've got very good budgets that tell you what a reasonable range is on the yields. Different soils. Ontario does too. Now, we've got two people on here who got, how the hell do you benchmark 75 or 125 crops if you're poopers? That's a little bit more difficult. But if you're in the standard corn, soybean, wheat, barley, canola, peas and so forth, those budgets will be really helpful.
Okay, and the other thing I would add is typically within farm families, if you're incorporated, you are usually trying to, max the expenses that you can expense. So keep that in mind when you're looking at your contribution margin or any of those things. If you've done something to maybe maximize that where you can expense it versus taking it personally, keep those in mind, your margins, okay? So just some things to think about, because that really is the reality of what we do. You are really going to try and maximize what you can expense. So just keep that in mind.
Okay, so in general, let me look at the top of this first. These results are quite consistent with work that was done by MNP 25 years ago, although what we're finding is the contribution margins are probably a little bit higher than MNP said, and because of the way we're measuring them, for the most part, the operating overheads are lower. And we actually used to have people from the U.S. teach our financial component and C team, and they actually also talked about that 35% and 65% as the benchmark. So there's a lot of evidence out there that top farms have actually pretty high margins compared to others. So again, that 35% operating efficiency, it says that you get 35 cents left after each dollar of sales, after you pay all of your operating costs, before you get to capital costs. So again, I'm just saying what I said before. If less, then revenue is too low or costs are too high. And you're not going to make it every year. I like to look at these things over 3 or 4 years, because if you have a drought issue one year, or a flood issue one year, or a really low price year or something like that, that's going to impinge on it. So some of these ratios are going to depend on where you are in the life of your business and that sort of thing too. So for example, and none of you, well, Raj would probably fit here. If you just planted a new orchard, you're probably going to have your orchard in your cost of goods sold. So you've got new trees in there, and that means that you got new trees in there. Your cost of goods sold is really high, and you don't have anything coming off the trees. So there's no way in God's name that you're going to have a 65% operating efficiency, a 65% gross margin until those trees get into full production. So that's the kind of thing you have to take into account the reality of what you're doing. So the simple generalization is such that when I see a number that's different than I expect, the first thing I do is ask questions to make sure I understand what's happening there before I go in and say, like, okay, maybe you have a problem. Could be just that I don't understand the situation. So this generalization of if less than revenue is too low or costs are too high is a generalization that you get to after you've asked all the right questions. Feedlots and wean to finish livestock operations would never have an operating efficiency ratio of 35%. There's no way, because you're buying your feeders, most likely your feed also, it's really low margin. If you got an operating efficiency ratio of 35 or 15% in a feedlot, I think it would be fantastic. It's probably more in the neighborhood of 10 to 12 for the top operations. Same with if you're buying weaner pigs and finishing them. On the other hand, I think generally horticulture operations horticulture operations should probably be in that same neighborhood. Yeah, I'll change that. I'll say more about horticulture operations when I get into the gross margin. Similarly, in general, the gross margin for profitable farms should be above 65%. Again, what that means is that you have 65 cents left per dollar of sales after paying fertilizer, chemical, seed, feed, and so forth. That's crop insurance. I put that in there. If not, yours are too low, prices are too low, or costs are too high. I do think it should be higher for hort, because in general, horticulture has higher value products, and therefore the seed and chemicals and fertilizer and stuff like that are not going to be as much. They're not going to be cheap, but they're not going to be as much proportionally to the value of the product coming off it. On the other hand, I would expect their direct operating expenses to be higher. So that's this direct operating expense. I think it's skewed in this. It's got support operations in it. We don't have enough sample size yet to break it out by type of farm. We're going to in the next round of data that we hopefully will get here in a few weeks as the income taxes start rolling in. But it does appear from the data that we have that there are differences like I'm talking about. We just don't have enough data to say anything with statistical significance. Yeah, so I think I've said everything I need to say about these. These ratios will will tell you if your operations need improvement and give you a good idea of your ability to generate cash. And again, I like to look at them over a number of years because they tend to make more sense that way. And of course, if you're growing all the time, they're always going to be a pain in the butt to look at over time because this year is going to be different than last year. Although gross margin and operating efficiency should be a little bit removed, except in the case of trees, anyway. And some other things. If you're expanding early in the year and something, and you actually haven't got the product until later in the year. If you just bought a bunch of milking goats, for example, and you've got them in your cost of goods sold, and you haven't got any milk out of them yet, that'll be one that you can't go on the 1 year operation. But in general, they're pretty good measures. Okay, stop me if you have questions, or else I'm going to go on. Okay, liquidity. Okay, this is now all about the balance sheet. So liquidity ratio measures do you have risk of not meeting your short-term obligation? And it's all about the current portion of the balance sheet. So here's the current portion of the balance sheet. Assets, current assets are cash, accounts receivable, inventory, and any prepaids you have. Current liabilities are it says bank indebtedness, and I tried to change that, but this is a picture, and I couldn't edit it. You want to think about this as the statement, or operating loan, I mean. Accounts payable and accrued expenses, your current portion of your long-term debt, so this is what you have to pay on your long-term debt this year, and then your annual taxes that are due. Okay, those are the current assets and current liabilities. Travis, are you on?
Yep, I'm here.
We had this conversation the other day, and I found out something about it. I was all pissed off about your accountant putting your demand loan in your current liabilities.
Yeah, they have to do that.
I know. I found out afterwards too. I should send my apologies to your accountant.
I didn't say anything. I talked to the banker, and he said that they had to do it. So. Yeah.
I talked to the BDO guys this week, and it's kind of a new thing.
Yeah, in the last couple of years or something, I think.
Yeah, you can't, and you have to wonder whether you want to take a demand loan. The idea here of a demand loan is that even though you've got a loan for long-term assets, it's set up in such a way that the bank can basically call the loan anytime. So as long as the bank can call the loan anytime, it's a current liability. If you have a mortgage against it and they can't call it, then it's got to go down below. So I guess that's the argument for it. I sure as heck wouldn't use it to calculate working capital, for example. But I learned something about it. It's the damnedest thing I've ever heard of. But your accountant is right, unfortunately.
Yeah.
Okay. So that's what you're looking at. Let me go back here. Okay, I did that already. Let's go here. So there are two major measures of liquidity. I like the current ratio. A lot of people will talk about working capital. So let me talk about current ratio first. They're just variations on the same theme. So the current ratio is the current assets over the current liabilities. So when they're taking your cash, marketable securities, over here. So let's say that's $200,000, and your operating loan, let's do this year, your current portion of the long-term debt, any accrued expenses you've got is $100,000. So your debt, your current asset, your current ratio is $200,000 of assets over $100,000 of liabilities. Okay, it's as simple as that. Generally, this is kind of a you'll hear slight variations on this, but generally, what most people will say, if your current ratio is over 2, and by the way, I would leave those demand loans out in calculating your current ratio, except for the current portion that's due. If your current ratio is over 2, then you're in pretty good shape, because it means you got lots of assets there that you can turn into cash, or that are cash or can be turned into cash to meet your short-term liabilities. If you're less than 1, it means that you've got fewer short-term assets than you've got short-term liabilities, and so you're going to have to scramble. You're going to have to figure out some way to get enough cash somehow or other to pay it down. So that causes you to be illiquid. Okay, and probably somewhere below it, 1.5 is where it gets dicey. I often will say 1.5 and up is pretty good for most types of farms. 1.2 is okay probably for dairy and poultry, because you've got steady cash flow coming, and so you don't have to worry about it very much. But most farms, it gets a little dicey below 1.5. So this is one of those things you want to manage fairly carefully to ensure that you've got enough cash to pay your short-term liabilities. Okay. Working capital is exactly the same thing, except with working capital, what you're doing is subtracting your current liabilities from your current assets. So in that case we had above, where we have $200,000 of current assets and $100,000 of current liabilities, my working capital is $100,000. Okay, and they'll often express that working capital as a percentage of your cash needs for the next year, to come up with a ratio that tells you how much you need. But to me, when you do that, you're getting back pretty close to the current ratio. So from a starting point perspective, I think it's good enough to think about that. So Heather or Raj, you want to say anything more about that than I did, or correct me on anything? Since Raj is the banker, we'll make sure he gets in here.
Everything sounded great to me.
Good. God, I passed it. I passed the banker test, huh?
Yeah.
Heather, you got anything? Have you had any experience here?
No, I agree with Raj. I think you did a great job explaining it.
Okay, good. Okay, I'm going to move on unless you have questions. The next one is solvency ratios. In the question that you
Larry,
addressed,
can I stop you for one quick sec?
Yeah, sure you can.
If your current ratio is too high, though, that is also an indication that you have too much money sitting there that's not giving you a return, right? I think that's one thing to actually note, if people have too much money sitting there and their current ratio is too high.
Yeah, I can use an example here. This doesn't change his current ratio, but it sure changed the way he was dealing with it. So we did a benchmarking thing with some of our C-team graduates a few years ago, and we have a client in Saskatchewan who had a 16-to-1 current ratio. So he's got $16 of current assets for every dollar of current liabilities he's got. That's a lot of current ratio. That's a lot of working capital. And I said, so what is it? Is it inventory or is it cash? And he said, well, mostly it's cash. I said, so what the hell are you doing? You're sitting there with cash in your bank, not earning anything. What in God's name are you thinking about? And so what he did, whether it's the right thing to do or not, is is I told him about some funds that he could invest in that were earning 5 to 6% in the short term on, at the time when interest rates were at 2. They were fairly low risk and they were still quite liquid. So it didn't change his current ratio, but it certainly changed what he was doing, what he was earning with that money that was just sitting there doing nothing beforehand. Now, what it also says is that you can move it out of there, and if you want to keep it in the business, if you got $900,000 of cash sitting in your bank account, you could actually make that go do something in the business. You could buy land, or you could do something to invest in the business. But it certainly is one of those things that sort of jumps out when I see, and I do see them from time to time. People have really high, some people have very high current ratios, and they're probably sitting there not using their money as effectively as they possibly could. Did I handle that okay, Heather? Is that what you wanted me to say? Or did I leave anything out?
Yeah, no. And not that many of us working in agriculture actually ever run across that problem, but if you do, it's just something to think about.
Oh yeah. Actually, in C-Team, I see more of them than it surprises me how big some of them can be. But there's some big ones in this BDO study too, interestingly enough. Okay, now I'll go on to the solvency. So solvency addresses the question is, do you have enough in the long term to pay off all your obligations? And generally there are two measures of this. I do not like, from a management perspective, the one that you hear the most frequently, which is debt to equity. That comes from the balance sheet. So let's go back to the balance sheet here again. So this is basically expressing your debt, all of this stuff in here, maybe all of this stuff in here, your current liabilities and your long-term liabilities as a percentage of your equity. Okay? And so going back to here, if your debt to equity is 1, it means your debt and equity are exactly the same. So you got $1 million worth of assets, and you own 500,000 of it, and the bank or your other creditors own the other 500,000 of your assets, basically. If your debt to equity is 2, it means your debt is twice as big as your equity. That means that's what we call being fairly highly leveraged. Okay, so you own less than the bank does, if you will. That's probably the easiest way to think about it for me, anyway. On the other hand, if you are at 0.2, it means you've got a very low level of debt, frankly, relative to your equity. Okay, so that's the whole concept. Bankers care a lot about this. Why do they care about this, Raj?
Just because it gets kind of scary if you're if you have too much debt and you're, for example, sitting at like 1 is way too high. No banker is ever going to give you any more money. I think the cutoff.
What's too high?
Like if your debt to equity ratio is 1, that's like way too high. Usually, the highest that I've seen is 0.75.
I can show you a couple that are higher than that.
That's terrifying.
Yeah. So your concern as a banker is if they fail, you're not going to get paid back, right?
Yeah.
Exactly. That's what the banker's concerned about. The banker's doesn't want to give you much money beyond as Raj just said, beyond 1. Okay, because they want to make sure they get paid back. One of the first laws of finance is bankers always get their money. Okay, and one of the ways they're going to get their money is they're going to limit how much they loan to you if you don't have enough equity to pay them off if you fail. Okay, so that's their care on this, so there's an interesting thing here, and that's how do you measure your debt to equity? This gets really funny and weird, and we can go we don't have to go very far with it, but we can go forever with it. So a lot of farms were bought over the last 30 years. So you might have bought the farm for, $2,000 an acre 30 years ago, and you're probably carrying it on your books at whatever your cost was 30 years ago. Okay, so if you look at your debt to equity ratio and you use your cost of acquisition as the basis for your valuing your equity, you probably have you can have a fairly high debt to equity ratio. Okay, so but what we find is that banks actually lend way more than you would expect, because you've got a lot of off balance sheet value. Okay, because your true value of that $2,000 an acre land is maybe $15,000 an acre, depending on where you are in Canada. And so your true debt to equity ratio is much better, because you've got what I call off balance sheet value. It's the stuff that is valued at cost, and its true value is much higher than that. So there's debt to equity ratios and there's debt to equity ratios. But it is very clear that bankers like this one a lot, because they want to make sure they get their money. From a managed perspective, I like this one better. You guys, Rod, you probably have used your debt service ratio. This is a variation on the theme, debt service. So this is the one that I like to pay attention to from a manager's perspective, owner manager. So this one is debt to EBITDA. Okay, so you got two things going on in here. One is your operating earnings, and the other is the amount of debt. And I particularly will pay attention to funded debt, because what funded debt is your bank debt. So if you got operating loans in here, the current portion of your long-term debt, and that's a bank loan. You got long-term debt or long-term notes or mortgages that are with banks or lending institutions. Those are the ones that I'm going to pay attention to. If Dad's got a mortgage that he's holding, that he may not foreclose on if you get in trouble, that's not as important in calculating this. What's important is the guys who will actually foreclose on you. So I pay attention mostly to funded debt. Okay, so it's funded debt to EBITDA. It tells me how well my operation can service my debt. So if I owe banks $2 million and my farm generates EBITDA of $150,000, what's my debt to EBITDA ratio? I got to use my calculator to answer this question. Somebody tell me. I didn't work it out. What's my debt to EBITDA ratio if I have $2 million in debt and I have $150,000 of EBITDA? Nobody can do this? Have I lost you?
I think I got 13. Well, I just did 2 divided by 0.15.
Yeah.
13.
13?
Yeah.
Okay, 13 to 1. So what does that tell you? How would you and this is, by the way, on the debt side, it's the principal. So what does that tell you literally? What it tells you literally is, if you do nothing with your EBITDA, and let's go back up here again. And to this, I like this one slide that Heather put in. This one, I think. Yeah. EBITDA serves 4 masters: capital, lenders, shareholders, and taxes. Okay? So what this says is, that, that's not it yet. That if I do nothing with my earnings before taxes, or sorry, earnings before depreciation and amortization, except pay it on principal, pay down principal, it's going to take me 13 years. Okay? I can't spend any, I can't pay any taxes, I can't pay myself, I can't invest in anything new, and I don't pay any interest during that whole period of time. Okay, so if you got a 13-to-1 debt to EBITDA ratio, that means you are extremely highly leveraged. And by the way, I see them a lot. Okay, that high. If you got $500,000 in operating income or EBITDA and $2 million, that means it's, I believe, 4. Okay? So now it says if I do nothing with my operating income except pay down debt, it's going to take me 4 years to pay it down. That's a whole lot better. You're not nearly as risky, and if you're at 1.5 million, it's going to take you less than, obviously, it's going to take you less than 2 years to pay it down. Okay, what I find, so this is interesting because we did a study a few years ago when we had tax filer data, and the average debt to EBITDA ratio in Canada for agriculture was 5. Okay, so on average, the average farm is going to take, if they do nothing but pay down, take their operating earnings to pay down debt, it's going to take them 5 years. I was on a board of directors of a company outside of agriculture, which was very profitable, didn't have a lot of debt. When we refinanced our credit, what do you call it? Our credit portfolio. We had a covenant that said we couldn't go above 3.5 to 1, and yet the average in agriculture is 5. So why do Aggies get 5 to 1 and non-Aggies get no more than 3.5 to 1? And the answer goes back to that off-balance sheet value. You often can get much higher loans in agriculture because you got off-balance sheet value because of land and quota. Okay, so with all due respect to bankers, they'll tell you that they loan on the basis of cash flow. Actually, they do to some extent, but they mostly loan on the basis of equity, asset values. So so number one, this is an interesting thing. Number two, if you're 5, 6, 7, or 8, or 9, or something like that, which many farmers are, that puts you in a very risky situation. If things go bad, you're going to have trouble meeting your long-term obligations. What I like to see from a management perspective is, so 2 or 3 people that I've worked with, and I mentioned the ones who are running for Outstanding Young Farmer of Alberta right now. They do it this way. We go take a big bite, and we might get this thing up to 4 to 1. Okay, so we got 4 to 1 or 5 to 1 even. But before we go take another bite by buying another farm or another big piece of equipment, we actually pay it down and get it back down below, certainly back down to 2.5 or lower than that. So this is what I mean by they take a bite and then they chew it up and they digest it and then they grow again. Where you may have trouble, look at the outlook right now with grain prices not very good right now, and probably another big crop coming in South America and so forth. It's easy to go out and buy a whole bunch of land today and get yourself, probably borrow the money on it and get yourself at a 8 to 1 or 7 to 1 debt to EBITDA ratio. But then can you pay it back in a few years? That's the issue here. So to me, the ratios that I don't know if I actually said this. Yes, there we go. In my view, debt to EBITDA above 6.5 is quite risky. You can go higher than that, and again, these days in dairy and poultry, because of supply management. but you do have some big risks there if you're in it. Debt to EBITDA below 2 puts you in a very good place to invest and grow if that's what you want. There's probably a happy place in there on this, that maybe around if you want to grow over time, probably going back and forth between 1.5 and 3.5, or 1.5 and 4.5, or somewhere in that neighborhood is not a bad place to be from a long-term management perspective. And I see an awful lot of people who are in this 6.5 to 7, 8 range, and I think it's very risky. Okay. I'm preaching again, and I apologize for that. My last set of ratios is the profitability ones. They measure overall profitability, and generally we think about them as return on assets or return on equity. Return is usually earnings before tax, but what can be earnings after tax. So from the come on, what I'm looking at here. Okay, I got to use both hands. I'm gonna put my phone down a minute. Should have brought one down. Yeah. Okay, so on my income statement, it's this earnings before taxes is my measure of profit. So it's overall profitability, and I'm going to be dividing that by my total assets. Oops, total assets over here. Okay, or it's going to be my earnings before taxes divided by my total equity over here, down here. Okay, those are the two ways we usually measure long-term profitability. Again, I don't want to use this, I don't want to try to measure myself on 1 year. I want to look at over time. So assets is total assets and generally, personally, I like to do this at cost, but there's a reason for doing it at market value sometimes on your assets. But when I bought the asset, I paid for it. I expected to get a return for it. So I'm not going to penalize it by now expecting it to return me a higher level than I said I would expect when I bought it. So I like to do it at cost. Equity is total equity, and obviously, maybe not obviously, it doesn't seem to be always obvious. If you have any debt at all, your return on equity will always be greater than your return on assets. So for example, if you've got earnings before taxes of $100,000 and you have assets of $1 million, half of which is equity, then your return on assets is 100 over $1 million total assets, or 10%, and your return on equity is 100 over $500,000, which is 20%. Okay, so your return on equity, as long as you have any debt at all, your return on equity will always be higher than your return on assets. It's simply, that's the whole concept of leverage. In my experience, which I'm not sure how many of these I've seen, but in my experience, return on assets in agriculture of 6 to 8% is pretty good over time. On equity depends on what your leverage is, but I think, Heather, you like to have a higher return than that, but you're probably a better manager than most. Am I correct? Do you have a target above 6 to 8%?
Yes, I would, but
yeah.
Not saying that you always achieve it, but yes.
Yep, 6 to 8% seems to be. I see a lot of people less than in return on assets. I see a lot of people with return on assets over time less than that. 6 to 8% is probably not a bad average. We go back to the strategy piece. If your strategy is if you're trying to use a strategy to make yourself more profitable than the average in the industry, then you're looking at something that's going to be better than 6 to 8% return on assets.
And I will just say that as the price of land is going up, it makes it difficult if it is purchased in the company.
No
So
question.
just a heads up.
No question. Okay, so that's what I came to say. Any questions? Because I want to see if I can get you to. Well, any questions? Did I make sense with that stuff? Does it help?
I think you probably read some of it and stuff we've sent you, but does this? Yeah. Any questions? That's enough to say it, I guess. No questions. Okay. Okay, I saw 2 lights go on. Oh, one of them's Heather.
Yeah, it's from here. I think I'm just curious now to make my own spreadsheet and put in my numbers.
Yeah. So I don't know if you looked at this, but I'd like you to see if you can have a look at these. These are actually based on farms that I've seen in the past. Believe it or not. So what I think I'd like you to do is tell me about the performance and financial situation of the following 4 farms. So that's the question. So let's start with farm number 4. What can you tell me about that farm by looking at those gross margins? I put a contribution margin in there too, but actually I think there's a mistake in there. It shouldn't be 1.2.5. It should be 1.5. So how's Farm 4 do it in terms of performance?
Not well.
Why not?
They have a very low gross margin.
Yep.
And the EBITDA is really high.
No, it's low.
It
should be 35%, and it's 20.
Oh, the 35.
Yeah. Yeah. I think what you meant to say is right. You just said it upside down. So that should be 35%, and it's 20%. The gross margin is 55%. Okay. So why do you think their gross margin? Why do you think their operating efficiency is too low? Sorry, why do you think? What do you think is the problem? I'll give you a hint. This is actually a horticultural operation.
Is it that they're like their overhead's high, like their hydro and labor and stuff like that?
No, that's not the thing that jumps off the page. Did somebody else?
Their debt is at 6. They have a hell of the cash that the company is generating. They're high leverage.
But that doesn't explain this because that doesn't come into this equation, right?
Yeah, that's right.
Yeah, you are totally correct about what you said, but that doesn't explain why their operating efficiency is low. So I want to make a point here. This operation has a very low. Remember I talked about that direct operating expense should be 27%. It's only 10. They really have their costs under control for the direct operating expense, especially for a horticulture operation. It's fairly low. So the problem right here, this ratio, this gross margin ratio, it should be probably 70 to 75% on a horticultural operation. It's not trees, so I can't, there's no excuse for, having just bought a bunch of trees that haven't started into production yet or anything like that. It's just crappy yields and crappy prices. And so their problem is right there. That should be, if you got that to 70%, it would take your operating efficiency ratio to 35 right away. Especially when you got cost control like you've got here. Okay, and interestingly, was it Travis who talked about the debt to EBITDA? Or who said that? Who said they were highly leveraged?
Yeah, that was me, Curtis.
Oh, Curtis. Okay, you're right. But interestingly, if you could raise your operating efficiency, it would automatically lower that, wouldn't it?
Yeah, true.
Yep. So there's two ways you get unleveraged. One is to increase your operating efficiency and start generating more cash, and the other is to pay down debt. But partly as a result of having very low operating efficiency, they have a lot of problem with debt. It's a pain. It's been an ongoing issue for them, and it's right in there. Okay, you see how hopefully it begins to show you how it helps to understand where do you focus. These people don't need to focus at all on their operating costs. Not at all. They're in great shape there. Their overhead's okay, but where they really have to focus, they need to generate a hell of a lot more sales than they are. It's either usually low and they're in there. Look at Farm 1. Tell me about Farm 1. Yeah, no, let's not do that. Let's look at Farm 3. That's more interesting.
They're not doing good. Their operating efficiency is really low.
Yep, absolutely. What are they doing well?
Their
The gross margin.
Yes, gross margin is really good, 78%. Okay, but what happened here? We got 60% of their sales is spent on operating labor and machine equipment operations. It's ridiculous. Okay, so where do they do you see it? Make sure I'm making sense to you. Nobody's saying anything. I can't see something.
Yeah, I agree with you.
Okay. Now let's look at Farm 1. How are they doing?
They're doing pretty well as far as I can see.
Yeah.
Their operating efficiency is fairly low, but otherwise they're controlling their costs relatively well, and their current ratio is good, and their debt to EBITDA, they're servicing debt well.
Yeah. That's that could be that farmer I was talking about in southern Saskatchewan. That's 15. This is 1.5. It's 15. You had $15 of current assets for yellow rate of current liabilities. He's got no long-term debt. So you're right. He's doing pretty well. He's got, he can sharpen up a little bit, But if this guy wanted to grow, he's got all sorts of opportunity to grow because of he's got cash in the bank or in the inventory, one of the two, and he's got all sorts of borrowing power.
Yeah.
Okay, so you compare that one to either one of these two, and which one would you rather be?
I'd take farm 1.
Yeah, I think so. And then let's look at farm 2. These are, by the way, real farm, or close to real farm anyway. I changed them a little bit to protect the innocent, but not much.
I'd say farm 2 is relatively healthy.
Absolutely.
Like, they're definitely, well, they're servicing their debt.
The margin is really good. They're over 70%. This is, I believe, I'm trying to think what this is. I believe this is a cash grain operator. So the gross margin is really good. They're doing really well on operating efficiency. They got lots of current assets. Not bad here in terms of their operating costs. And they've got some debt, but not a huge amount whatsoever. And they're in pretty good shape. So it's interesting when you look at these and you say, what if all these farms were together in the same area and a fifth farm came up for sale? Who's going to get it?
Farm 1 definitely.
You got it. Most likely.
Farm 2 would probably be more aggressive. They seem like a little bit more wanting to grow, but yeah.
You are absolutely correct. That's very good that you point out. That's exactly the case. That farmer is aggressive and is growing. This one is is pretty happy with where he is. He should be. You're right. Farm 1 or farm 2 are going to be, it depends on how badly they want it. But one of the two of them are going to get the other one, and these guys are out to lunch. So that's what I like to do with this. Carmen said she'd like to do her spreadsheet now and see where she is, and that's exactly what you should do now. Is go look at your own stuff and see how you rank on this.
So I just want to add to that, and this is kind of the step in identifying where you do sit, but it's equally important every year to keep your benchmarks and measure against yourself so you can see the improvements. I think that's one of the key things we want to get across to you as well.
So I hope this helps. And it's where I but I'm happy to answer any questions. It is 9 years, my guy. I managed to hit the target. Okay. So I think our next meeting will be on the 21st. Is that what you said, Heather?
Yeah.
Yeah.
So I will, as I said, either Larry or I will send the go-to out to you closer to, and we'll get the summary from Merle as well as presentation to send out to you ahead of time. But in the meantime, this is